Will commercial real estate implode in 2024? Let's take a closer look. Since the post-World War II days, the concept of work, and therefore commercial real estate, has remained largely the same. You have a home, you have an office, and as you move daily from one to the other, you create profit for thousands of businesses and individuals. But skyrocketing costs, new technology, and a rise in working from home are drastically affecting the American office space market. Trust me, the United States is facing a global real estate implosion. Can we stop it? Should we stop it? Well, that's what we're going to discuss in this video. Thank you for watching this video. But before we begin, if you could, please take a minute to subscribe to my channel. And if you enjoy this, make sure you hit that like button. Also, if you know someone interested in options, please feel free to share this video with them. Now let's get started. Real estate, perhaps more than any other type of commodity, has a certain ebb and flow to it. There are a wide variety of markets, classes of properties, and strategies that for the most part have allowed commercial real estate investors to profit in both good times and bad. After all, if one city or market is entering a downturn, no doubt there will be others entering an upswing. As the supply and demand shifts from market to market, the cycle renews and continues. But this is simply not what we're seeing in 2023. As of the most recent estimates, the U.S. boasts 5.9 million commercial buildings containing some 97 billion square feet of floor space. Though this includes factory space and other such facilities, a fair amount of this is specifically dedicated to office space, and that's where we're going to focus our attention. After all, it is office space that's bearing the brunt of this new threat. So what exactly is happening? It doesn't matter whether you're a worker, a company owner, or a real estate investor. It's impossible to doubt that the real estate landscape is currently undergoing a seismic shift. And while it would be great if we could simply point to a single factor that needs to be addressed, the real reasons behind all of this are more akin to a perfect storm. First, there's the issue of increased automation and productivity. Thanks to rapid technological advancements, businesses now require fewer employees to perform the same tasks. This in turn reduces their demand for office space. In fact, some companies have closed their offices altogether for no reason other than they've advanced out of them. The second factor is that the rise of remote work. This was already starting to become a thing in the late 2010s, but as we all know, it got a significant boost during the COVID-19 pandemic. As more employees discover the advantages of working from home, it becomes harder and harder for companies to keep them in the office. But the advantages don't end with employees. Companies are saving billions by putting their workers out to pasture, especially as they find themselves facing increasing office space costs. This brings us to the third factor, tightening the noose: rising interest rates. Commercial real estate often relies on loans with shorter terms than their residential counterparts. As interest rates surge, it becomes more costly for businesses to finance office spaces, further dampening demand. Indeed, interest rates are much higher than they were 5 or 10 years ago, and most businesses don't have the financial bandwidth to pay the new rates. These three factors, combined with secondary issues like inflation, changing sentiment about work, and others, have turned the commercial real estate market from the investment rock it once was into something akin to the boulder from the Raiders of the Lost Ark. And while it's certainly possible to stop it before it gets too out of hand, it's not going to be easy. You see, the consequences of these trends are already starting to emerge. Increasing vacancy rates loom large. For whatever reason, there are simply fewer people working in office buildings. This has led to dramatically decreased foot traffic to nearby retail establishments, causing what many economists are calling complete collapse of downturns. This in turn has put housing dynamics into a tailspin. As remote work becomes the norm, people are rethinking the necessity of living near their workspace. Why pay a premium to avoid a commute you don't actually need to deal with? The more people work from the living rooms, the more likely that residential occupancy in city centers will plummet, and so too will rental prices. Alongside this, economists anticipate an increase in defaults almost across the board. For instance, lenders may find themselves stuck with vacant office buildings. Moreover, regional lenders might experience financial hardships that put them in increasingly difficult positions. If the situation snowballs enough, it could lead to a significant uptick in bank failures. If you apply theories or micro and macroeconomics to these scenarios, It creates a situation in which rents will decrease dramatically for both commercial and residential properties. However, it's the Class B and Class C office buildings that will fail first and fail the most spectacularly. Of course, some markets are far more resilient than others. Therefore, as the office space apocalypse begins to make its way across the United States, not every area will suffer equally. Metropolises like New York, Los Angeles, and Miami, which all boast a high density of residential housing, as well as abundant amenities and growth, are much better equipped to weather the storm. On the contrary, mid-sized cities will bear the brunt of the impact. A single major downtown office building closure in a city like Columbus, Ohio, or Tampa, Florida, could send shockwaves through the local economy. But such cities are not only more vulnerable, they're also more numerous. This means there are simply more cracks in the economic wall, meaning more people and businesses will be left exposed. Fortunately, we are not entirely defenseless in this battle against complete commercial real estate implosion. In fact, there are some very specific steps we can take to minimize the effects of the changing work world and buttress some of our most vital economies. The first strategy: convert as many office spaces as possible into residential units. Now, due to some of the information I've already covered, this won't be a viable solution everywhere. This is because it necessitates strong residential demand. It also will be extremely expensive, so whoever decides to get involved will need some deep pockets. In cases where conversion isn't feasible, tearing down underutilized office buildings to replace them with residential properties or community amenities such as parks and recreation areas could offer a solution. Again, this isn't exactly ideal, but neither is the idea of having dozens of empty buildings rotting across a mid-sized city's downtown. In the end, every property will likely necessitate its own solution, and figuring out what that solution is could rely on an unprecedented amounts of community engagement and research. It doesn't take a financial whiz to know that the repercussions of the impending real estate implosion will extend to the stock market. As previously stated, the banking sector may bear the brunt of the impact, particularly if defaults become widespread. Investors should remain vigilant, as the failure of a regional bank heavily exposed to real estate could have ripple effect across the financial markets. Nevertheless, the overall market may remain relatively stable, providing it and the investors controlling can adjust to the changing landscape. In summary, the future of office real estate is marked by uncertainty and transformation. For young professionals, investors, and entrepreneurs, understanding these converging factors and their implications is paramount. While there are many challenges ahead, opportunities may also emerge as the real estate landscape reshapes itself. The key to success lies in adaptability and learning how to take a forward-thinking approach to this ever-evolving industry. Thanks for watching. If you have any questions or comments, please post them below. And be sure to subscribe and hit that like button. Good luck with your trading.